Once I had started to find my way into dividend stock investing, one question kept popping up. How do I know at which price I should buy this company? How do you figure out what a dividend stock is worth? Stocks like Microsoft, Pepsi, Johnson & Johnson or Visa, for example. At what price should we buy them? And the answer to those questions is exactly what we will talk about today. We will learn how to value a company in a few minutes by looking at their dividend yields. Let's get started. Hi everyone, this is Tom from the Dividend Attitude. Today we will learn how to value a stock using the dividend yield theory. We will use the dividend yield as a thermometer to gauge whether a stock is currently on sale, undervalued, just the right price, fairly valued, or perhaps very expensive, overvalued. See it as buying something in the store. Would you rather buy the television when it is on sale or when it is most expensive? Exactly. That is also how I think about buying dividend growth stocks. Now, one of the obvious prerequisites to using the dividend yield theory is that the company pays out a dividend. There are actually a few more prerequisites, but I will get back to that later. At the end of the video, I will also show you an overview of my portfolio and the performance so far, so stay tuned. Let's look at an example of how to value a stock with the dividend yield theory first, and after that I will explain how it works and how you can make these calculations yourself. I made a list of 10 companies here, and in one blink of an eye I can see how the stock is currently valued. Is it green, like 3M? Then it is undervalued. Is it yellow, like Visa, Johnson & Johnson, etc.? That means it's neither under or overvalued. Is it red, like Microsoft? Then the stock is overvalued according to the dividend yield theory. In the columns you see the yield and price at which the stock is deemed to be undervalued, overvalued or fairly valued. The idea behind the dividend yield theory is that the yield trends in a yield channel which marks the under and overvalued territory. Very much like you can see here in the graph of 3M, where the blue line is the price of 3M and the orange line is the overvalued territory and the red line is the undervalued territory. And the green line is the fair value. As you can see here, 3M is trading below the undervalued territory, so according to the dividend yield theory, 3M is currently undervalued. Going back to the spreadsheet, we can generate these yield channels by calculating the high yield and low yield of a particular company. If we take Johnson & Johnson for example, the high yield of J&J is 3.43 and the low yield is 2.46, while the average 5-year yield is 2.72. Based on those yields, we can calculate the price at which a stock is under, over or fairly valued. And again, don't worry, later in the video I will show you exactly how to do this by yourself. If you like what you're seeing so far, don't forget to give the video a thumbs up so more people can benefit from this content. Me and my buddy the YouTube algorithm would like that. So now that you've seen the dividend yield theory in action, what is the dividend yield theory and how does it work exactly? The dividend yield theory is the theory that high quality companies with stable earnings and business models, which have paid dividends for long periods of time, can be valued by looking at their dividend yield. The premise is that these companies have predictable patterns of overvalued and undervalued dividend yield, and that the dividend yield always reverts to the mean, the average dividend yield. The dividend yield theory is outlined in the book Dividends Don't Lie and later again in the sequel Dividends Still Don't Lie and is popularized by Geraldine Weiss. Remember, the yield has an inverse relationship with the stock price. So when the dividend yield is high, the price is low, showing undervaluation, whereas a low dividend yield correlates with a high stock price, showing overvaluation. In the example I already showed you a little bit why it makes sense. Dividend yields from these high quality companies tend to refer to the mean, the average yield. So we can predict our return when we buy the stock at a certain price. The reason behind it is that the stock price tends to follow the earnings over time. And if a stable company, blue chip, pays out a consistent amount of dividends from their earnings, a stable payout ratio, then the stock price could be connected to the dividend yield as well. Like I said, Geraldine Weiss popularized the dividend yield theory, which she did in her Investments Quality Trends IQT newsletter. According to the Hallberg Financial Digest, which you can see here, the newsletter has outperformed the S&P 500 over 30 years by 1%. That 1% difference might seem small, but over 30 years that really adds up. The usual way to express it clearer is to take a $10,000 investment and compound that over 30 years. If we calculate that with this investment calculator, we can see that over 30 years a return of 9.97% would give you approximately $173,071. With a 10.98% return, that $10,000 would give you approximately $227,686. That is a whopping difference of $54,597. I don't know about you, but that is like a yearly salary for me. Now, if that hasn't convinced you yet, let's see with this beautiful piece of software called Fast Graphs how that works. If we take 3M and calculate the yearly return when the dividend yield is high versus when the dividend yield is low, we will clearly see why using the dividend yield theory makes a lot of sense. Let's take 2008 for example. Dividend yield here was 3.48%. We then calculate the return for 10 years, is approximately 10 years. We see that the total annual return is 18.2%. If we then take a low yield point and calculate the return there, we will clearly see the difference. So we take the yield point here, 2004, it was at 1.55. So from there, 10 years later, so 2014 is approximately 10 years. And you see that the rate of return is only 6.5%. So there's a huge difference. So you can clearly see here why the dividend yield theory works. And now back to the sheet. Like I promised you, I will show you exactly how you can calculate these values yourself. So the orange columns are the columns we need to fill in ourselves. We have to fill in the ticker symbol in order to calculate the current price and the annual dividend. And then the current yield will be calculated. And we have to fill in the high and low yield points and the average 5-year yield. To start with the average 5-year yield, we can take that straight from Yahoo Finance. You can see it here. 5-year average dividend yield is 0.63. We use that to determine our fair value based on the dividend yield theory. And then the high yield point, which is 0.81. And as you can see, I calculated by taking the two high points. And if we go to Seeking Alpha, I can show you exactly how. If we have the period from 2014 to 2020 here, that there's one high yield point here, 0.79. If we zoom in further, there's another one, 0.81 here. We divide that by 2. We get 0.80. We do the same for the low yield. I'll zoom out again. There's an extreme one here. It's at 0.60. We zoom out again. There's another one here. 0.53. 52. Let's zoom in a bit to narrow it down. So the bottom is 0.51. So we fill that in. 0.63 and 0.51 to get a low yield of 0.57. And based on the high and low yields, we can calculate the price where it's undervalued and the price where it's overvalued. And we consider it under or overvalued if it is within 10% of the high or low yield. That's how I calculated the undervalued and overvalued yield. And if we then calculate that based on the current yields, we can see that Visa is actually neither over or undervalued. If we then enter the high and low yield values here in another sheet, which is actually made by someone called Div4Sun. I'm not smart enough to make these sheets myself. But anyway, we enter the ticker symbol here and the high and low yields. And then we can see on the graph here the dividend yield channels. And if you have read the book Dividends Don't Lie or Dividends Still Don't Lie, you will recognize these channels. Because that's also how Geraldine Weiss outlines them in her book. So again, here you see the blue line is the price, the orange one is the overvalued, and the red one is the undervalued. And the reason that they're going up and up is because Visa is increasing their dividends, so the dividend yield channel then also moves up accordingly. So here you can see that Visa, also in the graph, neither is under or overvalued. Now let's take a look at an example. We'll have 3M here. First we're going to look at the average 5-year yield on Yahoo Finance. Then we're going to look up the high yield. We're going to do that on Seeking Alpha. We see if we go to October 2011, I'll zoom in a bit right here, that it tops out at 3.7. So we write that down. Then I zoom out again. This is pretty similar. We see again here in October 2019. So we'll zoom in a bit again, that it tops out here at 3.77. So we also write that down. And then again, if we zoom into the last peak, we can see here that it topped off at 4.91 in March 2020. So we write those down here in the sheet. We get an average high yield of 3.92. We do the same for the low yield. Zoom out again here. We go to July 2011 and we see that it bottoms here at 2.19. We write that down. We zoom out again. So what we're doing here is we're looking for the extreme price points. If we're going to January 2014, and we can see that it bottoms here at 1.82. We go to April 2019. We can see an extreme price point here, 2.51, so we also write that down. And then again another one here, where it bottoms out at 3.18 in January 2020, so we write all those 4 down. We go back to the sheet and we calculate the average, and we get an average of 2.43. We then look at the prices, so the fair value is based on average 5-year yield of 2.21, and the price overvalued is at 2.28 based on the low yield. The price undervalued is at 156 based on the high yield. The undervalued and the overvalued yield are the point at which it becomes undervalued. So within 10% of the undervalued high yield, we determine that a stock is undervalued, and we can see here that with 147 and a current yield of 4%, that 3M is clearly undervalued. The dividend yield theory is a great tool to value a company, but with almost any value calculation, there are a few things to keep in mind. First of all, never solely look at the dividend yield to make a decision to buy a company. In my previous videos, I've outlined how you can research a stock. So first we determine if it is a quality company based on quantitative and qualitative research, and then we can determine the value of a company based on the dividend yield theory. Another thing to keep in mind is that we are only using 5-year average yield here. The longer time span, the more the data is accurate. And one thing I want to point out as well is in the book Dividends Still Don't Lie, they point out 6 criteria to determine quality or a blue chip stock. So you can also use those 6 if you want. First one is the dividend has increased 5 times in the past 12 years. The S&P quality ranks the stock in the A category. There are at least 5 million shares outstanding, at least 80 institutional investors. The company has at least 25 years of uninterrupted dividends. Earnings have improved in at least 7 of the last 12 years. And with these criteria, actually Visa would not fit it because Visa hasn't raised their dividends for 25 years. But still, I think it's useful to use the dividend yield theory to value the stock. And then on to my portfolio. My portfolio consists of mainly dividend growth companies. So companies that have raised their dividends for at least 5 years, and that is with the exception of CVS, which has frozen its dividend. The total portfolio value now stands at €6,727. In 2020 so far the unrealized loss is 20% and €1,656. So that's about the same as last week. Since the start of my portfolio, the difference between the S&P 500 and my portfolio is now at a bit more than 2%, so you can see that the return since the start is 18.54%, while the benchmark of the S&P 500 is 20.85%. And since this is a dividend growth investing portfolio, let's take a look at the dividends. In April, only Cisco has paid out dividends, and that will be the only company this month. If we then enter the dividends into my sheet, we can notice that compared to January, it is a nice increase of Cisco. And then my portfolio in the Giro. Not much has changed here. 3M is still a bit below break even, and SKT is still down significantly, and I expect SKT to be down for quite a while still. And as usual, both portfolios combined in Google Sheets. The total amount of dividends now stands at $726. The total value stands at $7,873, which is a negative 5.58% change compared to the cost, and a $465 negative change compared to the cost. That is excluding dividends. Including dividends, the change is a positive 3.12% at $260 compared to the cost. So nothing to write home about for 2 years of investing, but that's why we keep a long-term view. If you want to learn more on how to analyze a company, be sure to check out my How to Research Different Stocks playlist, of which I will also put a link in the description, and you can click on it here in the top right corner. I've also added a list of dividend growth investing books that I personally have on my bookshelf in the description. As always, if you like this video, please hit that like button and subscribe to get updated on future videos. Next up is a video on how to value a company with a discounted cash flow model. So if you want to get a notification straight when that video comes out, subscribe and turn the notifications on by hitting the little bell next to it. I suggest you to watch my video on Visa called Understanding a Business Before You Invest Next, which you can click on here in the bottom right corner. Until next time, bye bye.